Hello everyone, welcome back to my channel, The Learning Path. This is Dr. B. Meena, Associate Professor and Research Supervisor from Petition College of Arts and Science, Adayar, Chennai. In this video, I'm going to teach you how to calculate the payback period. What do you mean by payback period? Let me check first the meaning of the payback period. If you are going to invest in any business, so what is the duration to be taken to recover your investment? So payback period helps to determine the time required or the duration required to take back your investment. So this is coming under traditional method. Why it is coming under traditional method? Because it doesn't include the time value of the money. That is what the payback period is called it as a traditional method. Let me check out in the next slide how to calculate the payback period. Before we are going to calculate the payback period, we need to check out the problem whether we have a annual cash inflow ready-madely available. If it is not available, we need to apply this format to calculate the annual cash inflow. Annual cash inflow is otherwise called it as profit after tax and before depreciation. So whenever you have profits in the problem, then we need to compare the values of the depreciation and deduct the depreciation and get the profit before tax after depreciation and taxation to be deducted. Then the final answer will be profit after tax and depreciation. But annual cash inflow is otherwise called, as I said, profit after tax, but before depreciation. That's why we are adding the depreciation in this format to calculate the annual cash inflow. And once you calculate the annual cash inflow, you will be able to calculate the payback period by using the formula investment divided by annual cash inflow. So this formula we can make use when annual cash inflow is constant. So my dear viewers, this format you can make use to calculate the annual cash inflows. The annual cash inflows is otherwise called it as annual profits after tax and before depreciation. So once you knew this answer, using this formula to calculate the payback period is equal to investment divided by annual cash inflow. This is the formula you can make use when annual cash inflow is constant. Let me check the problems under this model. The next slide. Compute payback period for the following. Original investment is 15,000. Annual cash inflow is rupees 7,500. So we have the investment 15,000. Cash inflow is given in the problem itself. Simply use this formula to calculate what is the payback period. As per this problem, the payback period is 2 years. Next problem. A project costs 5 lakhs. Project cost is nothing but the investment only. Yields annually a profit of 80,000 after depreciation at 12%. The depreciation percentage is given and tax percentage is 50%. Calculate payback period. So we need to work out the annual cash inflows for this problem. So profit before tax and after depreciation is given as per the problem is 80,000. So I need to deduct the tax first of all. The tax percentage is 50%. On 80,000 it comes around 40. So the balance 40,000 is termed as profit after tax and after depreciation. So I need to add the depreciation. So how to calculate depreciation? The investment value is 5 lakhs. Depreciation rate is, what is that? 12%. So the given profit 80,000 is after depreciation only. So we deduct the tax only first of all. Then the annual cash inflow is otherwise called as after tax and before depreciation. So we are adding the depreciation again by applying the depreciation formula. What is the investment and what is the depreciation percentage? So 60,000 I'm getting. So what is the cash inflow? 1 lakh. So 1 lakh is the annual cash inflow. The investment value is 5 lakhs. So 5 lakhs divided by 1 lakh, it will gives you 5 years as the payback period. This is another problem model. And one more important problem model is under payback period is we have two type of machines. One is automatic machine, another one is ordinary machine. The cost of the machines were given, life in years were given, the annual sales and the cost is given. The sales and cost, if you compare, that tells you what is the profits for the respective machine. Compute the payback period and the profitability beyond the payback period. Give your suggestions, ignore income tax and depreciation. So we have two type of calculations in this question. Payback period, simply we are applying the formula investment divided by annual cash inflow. And one more question is profitability beyond the payback period. That's what the life in years were given. We will compare with the payback period and life in years for the respective machines. We will able to calculate the profitability payback period. So let me check the solution. Simply, that is work it out the format. What is the sales for both the machines and compare the cost as per the problem. That gives me 64,000 for the automatic machine, 20,000 for the ordinary machine as profit before tax and after depreciation. So since the problem doesn't have the tax and depreciation, just I have both the answers as my annual cash inflows, or otherwise call it as what it is, annual profits after tax and before depreciation. So in this problem we have payback period, that is what is the investment of uh, automatic machine, that is 2,24,000 60,000. So check out 2,24,000 divided by 64,000. What is the payback period for automatic machine? 60,000 divided by 20,000. 60,000 is the investment given for a ordinary machine. So 60,000 divided by 20,000. What is my payback period? 3 years. So this is one of the question asked in this problem that we completed. There is one more question in this problem. What is the profitability beyond payback period? So likewise, we need to calculate annual cash inflow of the respective machines into life in years. The life in years for both the machines were given. For automatic, it is 5.5 and ordinary, it is 8 years. So we need to compare with the payback period of the respective machines. Then we are able to calculate what is the profit beyond payback period. So 5.5 years for the automatic machine is the life years. And what is the payback period? 3.5 years. So I'll get the difference into 64,000. I'm getting 1,25,000 is the profitability beyond the payback period. Likewise, ordinary machine, I'm getting 20,000 as my annual cash inflow, and the life in years for the automatic machine was given 8 years, and payback period I calculate 3 years. So 5 years is the beyond the payback period. So how much is the profit? So 5 years into 20,000, 1 lakh is the profitability beyond the payback period for the ordinary machines. So likewise, I can able to calculate what is the profitability beyond the beyond the payback period, and what is the payback period by using the ordinary formula. So let me check out the conclusion part. The conclusion part is, as per the payback period, the automatic machine is 3.5 and ordinary machine is 3 years. So I can suggest we can buy ordinary machines because the payback period is less. But when I'm calculating profitability beyond payback period, the value, that is profits value, is more in the automatic machines. So when you're going to take a decision based on the profit beyond payback period, I can recommend to buy automatic machines. So this is the conclusion part I can give based on our calculation. Under payback period method, ordinary machine is preferable because of its shorter payback period. Under profitability beyond payback period, automatic machine is preferable because of its highest profitability. Let me check one more problem, the final problem under this format when annual cash inflow is constant. Kamraj Limited is producing articles mostly by manual labor and is considering replacing it by a new machine. There are two alternative models, P and R of the new machine. Prepare a statement of profitability showing the payback period from the following information. Ignore taxation. So we have the information about what is the estimated life of both the machines, 4 years and 5 years. The cost of the machine is 9,000 and 18,000. The estimated savings in scrap, estimated savings in direct wages were given. The cost, additional cost of maintenance and supervision costs were given. First of all, we need to work out what is the cash, that is annual cash inflows. By using this savings, comparing with the cost, that tells you what is the profitability. Just check out this format. So I just allotted the columns based on the machine and the particulars column. Estimate savings in scrap, how much, and then estimate savings in direct wages, how much for both the machines. Just add it and compare with the cost of the maintenance and supervision. Will tells you what is the profit before tax and after depreciation. Then deduct the depreciation first of all. So the depreciation calculation is part is, just check out the previous slide. What is the cost of the machine? 9,000 divided by 4 years. That tells you what is the depreciation for machine P. Likewise, calculate for machine R. 18,000 divided by 5 years. That's what I written here. How to calculate the depreciation part and then deduct the depreciation. So 2,250 and 2,400 for machine P and R. The profits before tax and after depreciation. Okay. So profits after tax. So there is no tax. So there is no tax. So it is called it as whatever answer we are getting, 2,250, 2,400 is profit after tax and depreciation. Then the annual cash inflows is always inclusive of depreciation. So add the depreciation once again, then you will get what is the annual cash inflow. Then investment divided by annual cash inflows, you will get the answer. 9,000 is the investment for mission P. So 4,500 is the annual cash inflow. Likewise, machine R, investment is 18,000. And what is that annual cash inflow for machine R? We'll get 6,000. So 2 years and 3 years. So as per this answer, we can conclude ourselves machine P is preferable because of its shorter payback period. So this problems under this video will tells you how to calculate the payback period when annual cash inflow is not given, as well as when the annual cash inflows are even, I mean constant. So thanks for watching my video. In this video, you are able to understand how to work out the payback period when annual cash inflow is not given and annual cash inflow is constant. Click the bell button to subscribe my channel. If you likes my video, please like and share the video to your known contacts. We will catch up you in the next video. Until then, bye bye.